Welcome to Bitesize Investments, a step-by-step approach to your investing journey. Today we're going to delve into the important financial metric that is used by investors and analysts to evaluate a company's profitability and performance. Our topic today is earnings per share, also known as EPS. EPS is used to measure how much profit a company generates per share of its outstanding stock. Net income refers to the company's total profit after deducting expenses and taxes. Preferred dividends are the dividends paid to the preferred shareholders, but this isn't always applicable to all companies. If you're new to investing, you may wish to pause the video so you could make a note of the following calculation when working out EPS. Net income, take away preferred dividends divided by shares outstanding. Don't worry if some of the terminology seems a little bit like gobbledygook. When I first started investing, no sooner had I found out the meaning of one word than another one popped up and I'd have to look up that too. Luckily for you though, I'm here to help you on your investment journey. So why is EPS so crucial? Well, it provides you with a valuable insight into a company's profitability on a per share basis. Investors often use EPS as a key factor when making investment decisions. Companies repurchasing their own shares can reduce the number of outstanding shares, therefore boosting the EPS. This is looked upon very favourably by Warren Buffett if shares are bought below the intrinsic value of a company. Now I hope you're sitting comfortably because I'm going to tell you a story about two companies. Once upon a time there was a man called Frank and he owned a factory. And just down the road there was a man called Glyn who owned a gym. Unfortunately, they were forever squabbling over who had the best business. One day, as luck would have it, a wise man called, let's say, Aaron Muffet, was walking past and heard them arguing about which company was the best. And like all good Samaritans, he interfered. He suggested that they should perhaps compare their company using something like, you've guessed it, EPS. So Frank went first and he boasted that his company had reported a net profit of $1 million for that year and bragged he'd paid his shareholders $200,000 in dividends. He also explained that he had 100,000 shares outstanding. Aaron Muffet thanked Frank for sharing this information with him and typed something into his phone. "Ha!" laughed Glyn. "Let me tell you about my company. My gym has a net profit of £2 million, and he rudely mocked Frank for his lower profits, and with an air of superiority he told them both he too had paid out 200,000 in dividends, and that he had 300,000 shares left outstanding. Aaron Muffet typed something else into his phone, and then whipped out a pocket calculator and said, "Now, let's work out the earnings per share of Frank's factory first." He then explained, when calculating the earnings per share, we start by putting in $1 million of net profit, and then we subtract $200,000 of dividends, and then we divide it by the 100,000 shares outstanding, which gives us $8 per share. This means that each share of the company's stock represents $8 in earnings. Both Frank and Glyn nodded along with Aaron's explanation, like most people do when they're not sure on what they've been told. Noticing their hesitation, Aaron quickly added, "Basically, the higher the number, the better the company is at earning money for its shareholders." Right, yeah, of course. Who doesn't know that? The two men said, and nodded in unison. Okay, well, let's do the same thing now with Glyn's gym, Aaron continued. Again, we enter $2 million net profit and we subtract the 200,000 dividends and divide it by the 300 shares outstanding, which gives us $6. This means that each share of the company's stock represents $6 in earnings. Aaron, like good strangers do, summarized his point. Well, despite Frank's factory having a lower net profit compared to Glyn's gym, its EPS is higher at $8, while Glyn's gym has an EPS of $6. This suggests that on a per share basis, Frank's factory is the more profitable. Frank gleefully thanked Aaron for his wise words and started to mock and celebrate his triumph in front of Glyn, whose expression had fallen and his persona had become a little bit somewhat sombre. Aaron waved them goodbye and both Frank and Glyn went back to their businesses, Frank incredibly elated and Glyn somewhat depressed by the news. Well, what a lovely story. But what does the difference in EPS tell us? Frank's factory was able to generate more earnings per share, suggesting a higher level of efficiency in converting its net profit into value for its shareholders. On the other hand, Glyn's gym, despite a higher overall profit, has a lower EPS due to a larger number of shares outstanding, which was somewhat distressing to Glyn. In conclusion, earnings per share provides a meaningful perspective on a company's profitability on a per share basis. In our comparison, Frank's factory with a higher EPS showcases efficiency in converting profit into shareholder value. Oh, lads, I forgot to mention, we could look at the revenue per share. And our final lesson is that we shouldn't just look at EPS when evaluating a company. And don't tell a complete stranger about the money that you make. Please consider liking and subscribing to the channel if you've enjoyed the content from today to help the channel grow.